doing business in Africa. You can't afford to be without Africa Investor.
Thank you very much, Xenia, and I think we all are very supportive and inspired by His Majesty's leadership, as we are equally inspired by each and every one of you in this room. I think you're hand-picked, you're doing incredible things, and that you are the momentum and the inspiration, which is why we believe that this new round of NDCs will be transformational. And we believe as the private sector, we have a very important role to play in reshaping the market. Reshaping the market, which will create an opportunity for private capital to flow and be constellated at scale, and for economic growth to be uplifted. So we are very pleased to be able to have this opportunity to convene and learn from each of you, and share some of the new initiatives and ideas that we've been developing within the SMI Africa Council. We have a comprehensive agenda for this afternoon. I know that someone said there's some form of climate meeting happening here in New York. I'm not sure. Everyone seems to be quite busy, which tells me that you place a lot of emphasis on Africa, climate and investment by being in this room. So perhaps let me just share with you what we are looking to cover. First of all, we're going to have some opening keynote remarks from the African Union, the African Union Development Agency, as well as the UN's Economic Commission for Africa. We're then going to have two panels which will run back to back. The first panel will be on a climate-adjusted asset allocation strategy perspective, and where we'll be looking at African green industrial infrastructure and nature as a globally competitive investable asset class. The second panel will be looking at bankable NDC projects and facilitating what we're describing as, and you'll probably hear this phrase sort of quite a bit, institutional investor public partnerships, which we believe are a really enfranchising framework that can mobilize private capital at scale and deploy that at speed for Africa's just energy transition. We'll have some closing keynote remarks from colleagues from the Great Green Wall Foundation, as well as the African Union Commissioner, who is responsible for the African Union's Committee of African Heads of State and Government on Climate Change, CAHOSC. And then we'll hopefully leave you with a little bit more inspiration, because we'll be recognizing some of our public and private sector investment leaders who are really blazing a trail on NDCs through our NDC Investment Awards process. So that's how we'll close out the session. The reality is, as I think we all appreciate, this is a really critical moment. We're going into a Baku for a finance COP. We're going into a nature COP, and we're going into the review and the deposit of new NDCs by February of next year. And people ask, and I was just speaking to the ministers now, we're looking at new NDCs that potentially had a private capital mobilization challenge. And now we've got a new assignment which basically says, raise the ambition. Let's keep everything the same way that it was before, but let's make them more ambitious and expect that we can actually get a different outcome. So we're here today with the solemn belief, and as I said, inspired by each and every one of you, that there's a different way for us to be able to work together. There's a real way to unlock the value of our infrastructure. There's a real way for us to be able to grow a green growth path. And there's a real way for us to be able to compete more equitably in the global green industrial economy, which is a $10 trillion per annum and growing global green industrial economy, which we are less than 2% of that. And I think if you bring long-term institutional assets together with portfolio companies that have domain knowledge and expertise in the key technologies, acting as universal owners where we have interests in both the public as well as the private market, we absolutely believe that this can be a transformational opportunity for all of us. And this comes on the back of, at the 37th African Union Heads of State Summit that we participated in earlier this year, our heads of state have really highlighted and given us a call to action. They talked about the $3 trillion worth of nationally determined contribution projects and investment needs that we have by 2030. And then they did the math. And the math showed that if we continue on our current path, where we're sort of led on private capital mobilization by concessional finance frameworks, there's only going to be about 10% of all of that financing that's actually required to address the $3 trillion from the private sector that can be met. So for the first time, our heads of state called on a new partnership with the institutional investment community that represent over 300 trillion globally of private institutional assets that have a real commitment and interest to drive an equitable, green and just transition. So we're very excited about the African Union's Nairobi Declaration. It is akin to, on many levels, the EU Green Deal or the market signals that were shared through the Inflation Reduction Act. And I think this is, again, a really interesting and unique opportunity for us to be able to partner and collaborate. I know that we hear quite a bit about whether the institutional investment community is really interested in Africa. We're sort of told that the private sector, there's not an alignment of views. I think you'll see from the first panel today, there are no greater, more prolific institutional investment community members or leaders that will not be on that panel. That panel that you're going to see coming up after this opening session collectively represents over $20 trillion of institutional assets. And there are many other places they could have been right now, and they've decided to be here. So I think that that really is a signal about the opportunity that we represent and the partnership that we can enjoy with our good friends and partners. So we have three key objectives for this particular summit. The first is to showcase our investable asset classes initiatives. I think, as Zenya mentioned this morning, we showcased our approach to how data is foundational and must be catalytic, because we need to take informed, insightful decisions for institutional allocations. So that was a very useful meeting and session showcasing one of our initiatives. But this afternoon you're going to hear some more. You're going to hear about how we are looking at establishing African green industrial infrastructure as a globally competitive investable asset class, and how we believe on a very practical level all of this value that we have in our nature can be something that governments can use on their balance sheets that will have a number of different positive effects and impacts. One, it will essentially add some value that is not being accounted for currently. And two, we believe that that will also positively improve the cost of capital. And three, managed correctly, which we certainly believe it can be and should be, has the potential to positively impact and influence credit ratings. And we know that those are some real issues that we're looking at the moment. The second of the three issues that we're going to be focusing on today as an objective is to consult and build momentum around our newly formed African Green Tech Demand Coalition and our Philanthropies Lab. We'll be working with key stakeholders from both of those communities to systematize collaboration around project origination, marrying that with long-term and long-duration bankable offtakes between institutional investors, philanthropies, and the private sector in support of the Nairobi Declaration, and our belief and our vision around how we can work together to establish Africa as an investable global green tech manufacturing hub. And then finally, as I mentioned, we're going to be recognizing leaders working on NDC investment opportunities through the NDC investment awards. So I just want to finally take this opportunity to thank our good friends and long-term partners at the CFA Society New York, as always, for being such gracious hosts. Please, let's give them, we're in their wonderful premises. We just had a lovely hospitality from them. And also Xenia, Sustainable Markets Initiative, the work of His Majesty, the partnership, we truly appreciate that. Similarly, our friends and colleagues from the African Union and the African Union Development Agency, and also the NDC partnership. Again, we thank them for their collaboration and their long-term partnership. And you'll see coming out of this meeting, we're actually going to start working much more closely with the honourable ministers to really find new innovative institutional investor-public partnerships to mobilise this private capital and develop some good industrial opportunities. So we're now going to go straight into this climate-adjusted asset allocation strategies panel with a focus on how we can all work together collaboratively to establish African green industrial infrastructure and nature as a globally competitive investable asset class. And everyone is talking about asset classes, but I think the operative words here in the phrase is globally competitive. And we really are saying to ourselves now, if you look at the current arrangements with the sort of public and development finance, that's a $1.5 trillion global collective balance sheet, including the World Bank, African Development Bank, Asian Infrastructure Bank, everyone together. But when you look at the private assets, we're talking over 200 to 300 trillion. So that have a very strong interest in our opportunities and our partners. So this is really the conversation that we're having. That's why we've brought together, the global institutional investment leaders to really have this conversation around blended investments. And I think the additional piece that we're bringing into this conversation, linking into the point that I made earlier that was raised by the heads of state, which recognize that the typical concessional capital that, to borrow the phrase, is available or should be directed to de-risk private capital's participation. We believe that there's a new form of strategic partnership that philanthropies, entrepreneurial philanthropies, can play, not necessarily to de-risk, but as we would describe it, to re-characterize that risk. And I think this is some of the innovative thinking that we're going to be calling on colleagues to share and discuss. I think I also mentioned in the opening establishing natural capital and Africa's nature on the balance sheet, and that's something that we're also going to touch on in this session. The climate agenda and the climate movement. We had a very interesting conversation yesterday where we had a philosophical exchange with a party that was basically saying we must go to each and everybody and sell them on the future of climate. And get everyone to make these sort of sacrifices, these early decisions now. And then I sort of interjected, which is why we have Duncan Bonfield on the panel, that the future generation's wealth is with the sovereign wealth funds. And if you can engage the sovereign wealth funds on a mandate around climate, around the sustainable development goals, you can probably speak to 100 institutions or so around the world rather than 7 to 8 billion people. And I think that that's not really fully appreciated or understood. And that's why we believe in the power of long-term institutional capital and the opportunities for everyone to collaborate. Similarly, on the pension funds side, we have the Investor Leadership Network, who have a number of different platforms and commitments as a collective, recognizing that this conversation can only start from scale. We're never going to get in front of this climate scourge or any of these challenges, SDGs, without changing our mindsets to dealing with scale. So I'm very pleased to have our good colleagues from the pension funds and the pension fund community, particularly from the Canadian pension fund community, on this. So let me just explain who they are. So we have Mr. Rich Nuzum, who is the Executive Director for Investments and Global Chief Investment Strategist at Mercer. I know it's a bit chilly, but we always like to just give a little clap. We also have Dr. Martin Stucci, who is the founder and CEO of the Land Banking Group, very innovative on nature. We have Ms. Amy Hepburn, who is the CEO of the institution I just referenced, the Investor Leadership Network, the G7's platform for global institutional investors and pension funds. The Future Generations Sovereign Wealth Funds. This is the man that holds it all together. Every single sovereign wealth fund in this world is part of his membership, Mr. Duncan Bonfield, CEO of the International Forum of Sovereign Wealth Funds. Gunther Tallinger, who is the chair of the Net Zero Asset Owners Alliance and a member of the board of management of Allianz. Gunther will tell you about the Net Zero Asset Owners Alliance himself. They've just had a very good session today as one of their big anniversaries, but it was convened by the UN Secretary General to bring asset owners together to provide leadership on the climate agenda. And then we have, last but not least, Sarah Kehion Williamson, who is the Chief Executive Officer of FCLT Global. So I've tried to do a very high-level summary introduction, or at least just by referencing the names. But I'd like us to just go along, Rich, right through to Sarah, to just give us this 2-minute perspective about your organization. We're going to get into the meat of it later, but just so that people in the room appreciate your institutions and your commitment and your interest in the continent and this subject.
So Mercer acts as an institutional investment consultant. We have about $16 trillion worth of assets where we're advising on strategic asset allocation across sovereign wealth funds, national social security funds, other types of investors, of which only about 20% is U.S. domiciled, so a global client base biased towards the larger end of the market. We've also been the project lead on the transformational investment workstream with the World Economic Forum, and other work streams that, like some of the organizations on stage, have brought together some of the larger, more sophisticated, more long-term oriented asset owners to try to have collective action. And the transformational investment work stream is one, brought together about 70 trillion in AUM across 50 or so leading sovereign wealth funds and insurers. And one of the questions we asked them was, what are the 6 biggest risks facing as long-term investors? And without any ESG overlay on it, they mentioned interest rates, they mentioned societal polarization, but climate was the top risk. As one CIO from a resource-based, an oil-based sovereign wealth fund put it, if we don't solve climate change, nothing else we do matters as an investor. We can't achieve our objectives of maintaining national wealth for future generations if we don't solve climate change. So that's some of the perspective our client base is bringing to this.
I'm actually from Allianz, the insurance group, but today here I talk about the Asset Owner Alliance. This is a group of 88 investors, 10 trillion total in assets. We are working now for 5 years, and that was what Hubert mentioned. We had the 5-year anniversary. We are convened by the UN. This is why, indeed, we get lots of support, also with the 5-year anniversary, but actually throughout the entire work. The interesting thing is we have been working on the topic of how we can really have forms of investments that reduce emissions overall throughout various forms of economies. That, of course, includes then also what is called the Global South. The key figure that you may want to remember is we are now able to report that across our portfolios, the absolute emissions are reduced by -6% every year. This means we have a group of investors who are indeed on the scientific pathway. So if you hear it's very difficult to do the -50% by 2030, the Asset Owner Alliance is a group that does the -6 to -7% every year and therefore is on the scientific pathway. It's doable. If I may translate this -6 to -7%, this means this group of investors is investing into the economic transformation. If we wouldn't do that, there wouldn't be a way to have the -6 to 7%. So also this is something that may be important to you. This 10 trillion transform gradually into the transformed economy. And this is, I believe, the reason why I'm allowed to speak here, because we have a very keen interest that a large part of this portfolio goes into transition finance across the globe, not only into certain economies, but into all of the economies, so that we can really leave the diversification principle for our portfolios. Many of our members are global investors, and that's why we believe we can contribute to this discussion. I'm looking forward actually to then explain what we can do to make NDCs investable.
So I represent a group of sovereign wealth funds, if you like, collectively represent them all. And I'll just echo what Rich says about the sentiment that these long-term owners have, which is they understand that the future is theirs. And the next generations, and they're set up to look after that. So they very definitely have this investing in the transition right at the heart of what they do, but they also remember that they have to get a return. So they have to balance those twin elements, and that's crucial in any discussions. Now, you'll probably know people like the Qataris and the Kuwaitis, who are big investment funds, and those Gulf funds and the Singaporeans and the like. But actually, the continent with the most members of my organisation is Africa. And one of the things that's very positive here is not only are the African funds deploying their assets in Africa, they're also helping to improve that investment process. So, and I'll give some examples a bit later about how that's going on. But what's very clear in this is that the best chance of improving outcomes is Africa has to mobilize its own capital to a large extent. So, and find its own solutions. So now, others can help in that, but that's absolutely crucial to this discussion.
Thank you. My name is Martin Stuchter, and I'm representing a company that I founded together with my co-founder, which is the Land Banking Group, which is a nature fintech. Before that, I was a senior and managing partner of McKinsey & Company, some shared history with some in this room, and I'm the founder of a group of companies called Systemic. But then comes 2020. Just to remind ourselves while we're in this room, that was Terra Carta. And Terra Carta also says that it is in support of a transition towards a world by 2030 when 30% of our planet are under some kind of protection status because we need it. And it also is in support of mobilizing the financial flows and the investments that are consistent with that pathway. And so in a way, we are dealing with two pathways. The one is a 1.5 degrees or a net zero pathway. But we also know from science that there is a planetary boundary. There is a good reason, ecological, economic reason actually, to move towards a 30%. Now, and those capital flows that are consistent with that outcome are falling short by anything between 2 and 3 orders of magnitude. And so it was in 2021 created a company which actually decided that on the way towards these outcomes, there are a few things missing, but most fundamentally, there's the financial infrastructure for trusted transactions and investments into that new type of infrastructure that we need so dearly, which is called nature. And we think now, for the first time, we have technology available that allows us to build that infrastructure, to give every pixel of the planet an ecological identity. We call it a nature capital account, which tells you about the stocks of nature, biodiversity, carbon, water, soils that really exists, and that allow us then to enter in fair, equitable contracts between those who are providing that nature capital, and these are billions of land stewards, and those who need it. We'll discuss that later, sort of how we are starting to realize that we need it in such a way that actually institutional grade capital can, for the first time, be deployed into this hopefully new asset class. And Hubert, a couple of us, and we found out that this is in fact an initiative that deserves to be part of the SMI ambition.
Hi, everyone. Amy Hepburn. I'm the CEO of the Investor Leadership Network. Super happy to be on this panel with so many changemakers. And Hubert, thank you to you. He has been an incredible changemaker in this space. You've been convening as long as I've been in my role as leading ILN. Hubert's been ringing the bell on this topic and bringing the right people around the table. So thank you, and thanks to SMI, our good friends at SMI. We love collaborating with you at ILN. So those of you that may or may not know ILN, we were formed during the 2018 G7 as a collaborative on how to support movement towards a more sustainable and inclusive society. We currently are 14 members. Representing over 10 trillion assets under management across G7. I say G7 plus now because we're also in Australia, that are really focused on driving impactful, tangible, trackable impact in 3 areas. And that is climate, diversity, advancing diversity in the financial marketplace, and the third is private capital mobilization in emerging markets. And so, this work we're doing here today really, cross-cuts all of these themes. Maybe what I would add, just to kind of frame the conversation from an ILN perspective, is about 3 years ago, almost 4, we partnered with the Rockefeller Foundation with a very specific question, and they said, help us understand what would unlock your members' capital in emerging markets. Help us really understand. It's, it's a collection of 14 members. It's not a huge group, but they're powerful and they're large, and a core are the Maple 8, the Canadian pensions. What keeps their capital on the sidelines? That research culminated in a paper, which then has continued and shaped our work over the last 3 years, and even in a call to action, which Hubert helped us put together for COP last year with other industry associations in the marketplace, really looking at what our call to action is. And I would say the work really falls in 3 buckets. What's keeping what are the solves for unlocking this capital? One is project pipeline, scalability. The second is better de-risking mechanisms. So really looking at concessional capital, what are the options there? And the third is on data, which those of you that were in the session earlier this morning, we talked a lot about GEMS and the importance of better data to allow us to price risk. So we're sort of up against this actual versus perceived risk conundrum in this space. So we've been doing a lot in that. I'm sure I'll talk about that a little bit later. But again, I think this, maybe I'll end by saying I think the path forward, that is both my proof of concept within our work at ILN, is that it is a path forward that is cross-sectoral and very collaborative, and that is where we're seeing our most success.
Sarah Williamson, the CEO of FCLT Global. FCLT stands for Focusing Capital on the Long Term, and that is our mission, which is to focus capital on the long term to support a sustainable and prosperous economy. We are a nonprofit, an NGO. We have 70 members around the world who are either very large asset owners, so some of the ones that are also participate in some of these other organizations, large sovereign wealth funds and pension plans, large asset managers who either invest in public-facing markets, so in the public markets broadly, or invest in private markets, so many of the large private markets investors around the world, and importantly, large companies, so companies that operate in many, many, many countries of the world. So what we are trying to do is essentially connect the dots between the asset owners, the asset managers, and the companies when it comes to deploying long-term capital. And so we think about how do we lengthen investment time horizons? Because obviously if you're only investing for today, this week, this quarter, you never get to any of the issues that we all care about. How do we have broad business objectives so that we have long-term value creation and in the broadest sense? And how can capital markets be a source of economic mobility around the world? So our interest in Africa broadly is obviously as an investment opportunity, as also is because our members are headquartered in 14 countries, but they operate in almost 200. So I appreciate your being here, and Hubert, thank you for including me today.
You're welcome, and thank you, everybody. I think hopefully we've got a sort of a sense of the institutional industry that has an interest in the continent and how accessible we all are in terms of being able to work together. But there are mechanics. There are mechanics to how norms and fiduciary responsibilities are expedited, and I think that's really where we think we can bring our two worlds together. We sort of have a culture that focuses on let's find projects, and then let's take as long as it requires to diligence and potentially develop and finance, operate and maintain those assets. We believe that the only way you can look at scale in terms of intermediating the opportunities on the ground with the large institutional pools of capital is if it can become an asset allocation issue. So if we can say, how can we position ourselves to attract a percentage of the 300 trillion, as opposed to how can we finance, tens of millions or billions of projects? And that's where a big disconnect has existed. So I'm going to come to you now, Rich, because you, as you say, you advise on over 6 trillion, and how do we get to, and you're working very closely with us in the SMI Africa Council, how do we get to this issue of making African green industrial infrastructure and all of the great endowments that we have, that the world is already investing in one form or another? How can we conglomerate that so that the value is added in the continent and investors can participate in the upside of that in the continent and help the just energy transition, but also still deliver climate, risk, and nature-adjusted returns? So perhaps you might tell us what your advice would be to the community, or how we should think about positioning African green industrial infrastructure as a globally competitive investable asset class. Small question, huh?
Okay, sure. So I'm going to give you a free consulting project right now and take you through the logic I would of a sovereign wealth fund or large national social security fund that's hired us to do asset allocation for them. And long term, I'm very optimistic about this because of three opportunities. So just run the math for emerging and frontier market infrastructure investment versus other asset classes that could be in your asset mix. It's going to have a better expected return than developed market infrastructure, because the perceived risks are higher. The actual risks may or may not be higher, but the perceived risks are higher. But the diversification potential across countries, 54 countries in Africa, other emerging frontier markets around the world, no two of which behave in the same way. So you get this mix of diversifiers that you can't get in developed market. And unlike public stocks, you can invest in NVIDIA, Microsoft, Apple, and arguably you're getting exposure to the global economy because they sell everywhere. But infrastructure projects aren't like that. They're very local. You're with the local GDP, the local political risk, on and on and on. So the diversification potential is much higher. When we run those numbers for any type of investor, even if they have no overlay on climate, no overlay on any SDG, no overlay on ESG at all, the allocation to emerging frontier market infrastructure goes to whatever maximum constraint they put on it. It's a super attractive asset class just on the merits. So now come to the climate overlay or other SDG overlay. Well, if you put another dollar in green infrastructure in Europe, where the emission curve's already been bent, and where the amount of infrastructure and green infrastructure investment being made has doubled over the last 10 years, you're having some impact on climate mitigation. You put that same dollar into Africa, and you're replacing decentralized diesel generation, or you're replacing charcoal, or you're replacing coal at a much higher rate than you would in Europe. The marginal benefit of doing it in Africa or elsewhere in the emerging frontier markets is much higher than doing it in the developed world. So once you put that climate overlay on it, whether you're doing it for risk-return purposes, universal shareholder, values alignment, impact, wherever that overlay is coming from, the bang for the buck that you get for doing it in Africa is higher. So again, another opportunity. And then the third opportunity, and this is kind of the clincher, is with any fund that thinks of themselves as sophisticated, and larger funds tend to have in-house staff, they don't get paid to be like everybody else, they get paid to do it better. We say, well, in any area of investing, if you want to outperform, you need to be early and be right. So a year from now, when we take your peers through this, are they going to see it the same way? And do you want to get your money in now and have them buy in behind you, or do you want to wait until this is well established as asset class? So those are the opportunities. The math goes there without an ESG overlay. The ESG overlays are very strong, and you can be early and be right. Now let's go to the challenges. anybody who's been peer group median benchmarked and is underweighted the U.S. large cap stock market or the Magnificent Seven has underperformed. So investors that have diversified in the short term haven't underperformed. That'll change at some point, but there's a strong tendency to say, why bother? We're doing well with what we have. Another challenge, the general partner community, even where they raise global emerging frontier market infrastructure funds, we've been very disappointed, but most of them don't allocate to Africa. They see it as too hard. They see that there's no country on the continent with an investor-grade sovereign rating. So how can we do infrastructure investment and tie up the money for that long with that kind of underlying credit? Now, there's lots of ways to mitigate that and so on, but where I'm going is the investors, having established the asset allocation, have to really police their general partners strongly if they want the money to end up in Africa or in emerging frontier market infrastructure. And another challenge is the recent underperformance of China. To the extent that large investors stepped out and started doing emerging frontier infrastructure investment, they started with China as the world's largest emerging economy and got burned by the last 3 to 5 years change in political environment, market environment, economic environment in China. And so that's put a blunt on it. But I see all three of those things, those challenges, as short-term and transient, and have some optimism that long-term, just the math and then the bang for the buck argument, and then if you want to outperform, you have to be early and be right, will drive money into this asset class.
Fantastic. Let me just follow up. We talk a lot about adding value to our resources and our endowments, and then accessing, the $10 trillion per annum and growing global green industrial economy. And a number of colleagues here, we've just formed a partnership as the SMI Africa Council with some of the larger demand coalition networks like First Movers Coalition, Clean Energy Buyers Alliance, Energy Peace Partners, and a number of others. To what extent do you believe that these demand coalitions that effectively offer long duration bankable offtakes, because classically they were market signals to project developers to get over the greenium, to get over that sort of cost of not being able to get to scale, how could they be used, in your view, to recharacterize risk if there's a long duration bankable offtake for, in the context of asset allocation?
I think that could be huge, because one of the big concerns of investors is around the currency risk. And although that's arguably a diversifiable risk, it's a very real risk. And I kind of beat up on the general partner community earlier and said they're not doing Africa. They view it as too hard. The problem with the general partner community is they're trying to get 12% or so IRRs, and they don't care where they get them. So if they can get that from doing U.S. green infrastructure investment under the Inflation Reduction Act, and that's in line with their mandate, if that's easier and they can get their 12% IRR, the principal agent issue is they'll try to do that. So the institutional client has to come in over the top and say, no, we've got plenty of U.S. GDP exposure, we have plenty of Western Europe, we have plenty of Japan, we need exposure in the emerging frontier markets. But then you get to the currency risk, the political risk, so on. So I'm gonna use a specific project that some of you may have heard about, which is the X-Links project, Moroccan solar and wind power being sold to the UK. One of the really elegant things about that project is that your counterparty, the buyer of the energy, is in pound sterling, and it's national grid, so it's effectively, arguably, the UK government. You don't have to hedge the currency risk. You don't have to hedge the counterparty risk in that one. So what you mentioned, the offtake coalitions don't even have to get involved, because your offtaker is a hard currency, sovereign, high-quality credit. That's brilliant. In many other deals, you're producing green hydrogen for export, you're somehow trying to get energy to global markets or even to local markets. That's where the offtake coalitions could come in to effectively do the same thing. Say, if you're going to invest hard currency and take this very high degree of currency risk and counterparty risk and so on, we'll come in over the top as another instrument besides political risk insurance, trade finance insurance, credit enhancement insurance, but a much more economic hedge. We'll do a contract for difference. We'll do something that effectively guarantees a price. And now the project just has to produce, because those other risks have been mitigated by the offtake coalition setting in and putting a collar around that.
So doable.
I think it's doable. I think in general we're struggling forward to 2 steps forward, 1 step back on all forms of blended and catalytic finance. So whether it's philanthropies taking the first risk or developing a project, and the early movers. So again, I beat up on the GP community early on. To the extent any institutional investors in the room or any of your members do Fund 1 that focuses on Africa green infrastructure, lots of other investors are going to wait for Fund 2, Fund 3. They want to see the track record of Fund 1. If you're doing Fund 1, our research would say you'll get a better return because Fund 1s with good teams tend to outperform Fund 2 and Fund 3, where they raise a lot more assets and aren't as hungry. But you're also creating a track record that will make other investors more comfortable doing it. And the same would apply for offtake coalitions stepping in and saying, we'll write this contract in Ghana and we'll take the currency risk, and we know there have been issues there and so on. We're gonna take that risk off the table to make this investable, I picked on Ghana, but any country that has a history of currency instability or any kind of issues, the offtake coalitions, if they're willing to step in on that can really help de-risk the deal.
Fantastic. No, that's really helpful. I think now we've got a good insight in terms of, the pathway to making African green infrastructure, a globally competitive investable asset class. But now let's turn to nature. I'm going to come to you, Martin, because the way you're working on it, very impressive. I haven't heard anyone not be thoroughly intrigued by why haven't we been doing this before? And why not Africa? And Africa's got such a huge competitive advantage and potential. Just tell us about your project, within the SMI Africa Council. Very interesting project indeed. Over to you.
Thank you. First of all, to give this a place on this panel where we are discussing how on earth to get more allocations towards green assets in Africa, let's sort of change our mindset a little bit and turn it around. And there's a very helpful document to that's the Nairobi Declaration, which last year, in 2023, was signed by many heads of state. And if you read it, it's in fact, it's quite inspirational literature, because it talks about what this continent has to give to us in terms of opportunities, also increasingly investable opportunities. And I think, and then it was all summarized in a moment which sort of also showed how powerful that reframing can be when William Ruto then actually took the microphone and said, look, all the assets are on the balance sheet. Africa has the carbon sinks, Africa has biodiversity, but it's not on our balance sheet. If it was on our balance sheet, the world would see how rich we are. So that was also, in terms of reframing this conversation, a very interesting moment. And I think there is a very robust science to support that this is, of course, very relevant globally. We do know that a third of biodiversity sits in Africa. We do know that much of the climate regulation and of the hydrological regulation, I mean, if we cut down the trees in Gabon, which is not a theoretical, which is very much a political choice that needs to be made by political leaders now, how to do land use decisions in this time and age. Actually, we will feel the ripples of that, the effects all the way towards the global north. So it's not Africa's problem, it's our problem, but also locally. It's very hard to describe a continent that actually has productive systems if we see that nature capital not being preserved. I mean, just the last 1.5 days of myself talking to large food brands that actually say that the complete failure of cocoa or coffee crop from Africa is a realistic choice now, unless we reinvest into that type of infrastructure, soils. Talking to last night for dinner, talking to a pharmaceutical CEO, where she says, let's be fair, 25 to 50% of our pharmaceutical formulations actually are somehow traced back to some of these very rich biodiversity reserves. Or talk about the mining industry, how for them it's a very, very critical question of will we have a license to go after these functional metals or not, and how do we have to behave towards the nature capital around it. So increasingly we can make a case that this, yes, holds asset value because it's a source of future benefits. And still we can't currently sit sort of very much tight-lipped without any proper financial instruments actually to tap this opportunity. We have a couple of instruments which are very which are part of the old world. Sort of, don't get me wrong. Sort of, we do have things like debt for nature swaps, which are very good, but they're very slow. We do have things like philanthropy, which is very good, but it's very small. We have things like voluntary carbon markets, which are very good, but they have been created for a completely different purpose. So they have not been created to crowd in significant institutional capital to keep a whole new infrastructure type nature safe. And then we have compliance markets such as Article 6, which are very good, but they're not here yet, and no one knows when they will arrive on this planet. Now, and so so we somehow sit between a world where on the one hand we actually see that this is economically more and more important, on the other hand sort of we don't really have a way to invest. But I think within these two there is a very interesting gray zone emerging that is much more nuanced than us saying, look, it's hard actually to look at this as an investable asset class. There's a couple of things happening technologically, legally, financially, politically, economically. The first one I talked about a moment ago, and that's very much sort of how also we come into this conversation. For the first time, we have a mix of Earth observation technologies, in situ technologies, genetic technologies, and AI that really helps us to understand and describe these stocks of nature that exist. So in a way that fiduciary grade decision making can actually depend on these outcomes. The second one, which is changing, is financially or legally, sort of the ability to actually create outcome-based contracts between the providers and the buyers. In a way that is much more scalable. I mean, just imagine a world where everyone who is making a land use decision, and these are millions and billions, actually could be very easily contracted and start to be rewarded for these outcomes. The third one is financially. Once we have these outcome contracts, then you can do things that currently we haven't really done. We can create a whole instrument or a whole inventory of different outcome-based financial instruments that are actually every time indexed on natural capital. So this starts with just intangible assets that sort of companies, we work with many food companies, where we have currently something like 1.5 million hectares under management in Africa. Many of them is food companies. They can actually take this onto their balance sheet as an intangible. That wasn't possible before. That's not just a technicality, that's almost a philosophical moment, the moment when money put into nature turns into part of our assets, part of our wealth, part of our future. Then we see things like outcome-linked loans, outcome-linked bonds. Then we see things like landscape funds, or we see things like nature asset companies. Every single time it's the attempt actually to turn nature outcomes into instruments. So we for the first time we have instruments to play with, and so we can move on to the question, why on earth would we actually, where are the incentives coming from to invest? And here again, if you look at large corporates, for the first time they actually realized how big their exposure to a healthy ecosystem increasingly is. So they are investing into insetting activities. We see a significant movement in 2024 has been quite remarkable when it comes to that there's a reassessment of what true and fair accounting really looks like. So are our accounts really reflecting the impacts and the dependencies we have? And so we think we are already on a journey, but now the real issue is how to bring off-takers into the conversation, which is very for our conversation with SMI here.
Okay, just can you give us that 30-minute snapshot of the
30-minute, are you sure?
or 30-second even, yes. I'd enjoy it. But Can you give us that 30-second snapshot of, the nature on African government's balance sheet? Because you have ministers here, very engaged and interested in these types of subjects. What can they take back and say, that's an initiative that potentially could work in my country?
So we have three or four.
Just the one. Just the one. Yes.
So I think essentially we can see evidence in countries that are able to do nature capital accounting and to show what kind of value actually sits in certain projects to get that to translate that into better borrowing terms that they have with sovereign lenders, and we have evidence of countries that actually have been able to turn this also into corporate private lending agreements. We have one project in Kenya where sort of basically the entire future benefits that actually sit in this project, this is a landscape restoration project, has been translated into something like 50 basis points improvement, and that wouldn't have been possible if you weren't able to actually demonstrate the concrete outcomes that are delivered year by year in terms of biodiversity, in terms of water, in terms of carbon outcomes.
Fantastic. No, thank you very much. That's very, very clear. But there's still the whole issues around that we continue to hear about in terms of political risk and foreign exchange risk. So I'm going to come to you now, Amy, and just sort of get your view about how asset owners, as universal owners, can programmatically de-risk this foreign exchange and this political risk associated when investing, obviously, in Africa. Particularly through co-investment opportunities for clean energy and sustainable infrastructure projects. And it's quite interesting because we are participating in one of the Inflation Reduction Act meetings as a delegation of institutional investors. And just the language is so different. That when engaging with the states in America, the whole question is, you are co-investment partners. Not that you're being interrogated as a potential borrower, but it's a joint initiative, it's a joint approach, and then, of course, that alignment makes everyone feel different about risks. But I'd be very interested to get your views.
Yeah, no, sure. And I appreciated, Rich, your comments around, both climate from a risk perspective, but more importantly from an opportunity perspective. And I want to say, as you think about that from the members I represent and institutional investors, Africa, the continent, is an opportunity, right? It is the future. It is, I was at a dinner last night, the percentage of youth that are under 25 on the continent is staggering. So the opportunity there, maybe framing my comments in that perspective, is not lost on institutional investors. However, if I were to speak very plainly and say the two things that keep capital on the sidelines, it is scalability, projects that can take a large check size. So my members would say they have to do just as much due diligence to write a small check as they do for a big check. So they are going to be writing bigger checks. So when you look at that, scalability matters in terms, and that's why infrastructure is a great area to focus on in terms of attracting institutional capital. But the holy grail is de-risking, right? De-risking, whether that's first loss capital, whether that's catalytic capital, because risk is the biggest challenge as we look at that. And not all risk is the same. I say earlier, risk is not a monolith. It's not just, all risk, right? There's reputational risk, there's currency risk, there's political risk. Yes, you can say it all, you can argue it all kind of rolls up together, but investors view that differently. So when you go to a CRO and you put a deal in front, they say, no, we're not going to do that. They might say, yeah, there's just too much reputational risk for us to make that investment in that country. Right? Now, they're also highlighting political risk and currency risk, but reputational risk. If a tough headline, hit about that country and that is going to reflect on you as an institutional investor, that board is like, let's think about that. I don't know. So I think that's really important. And so what I would take away for this audience, because I know we have ministers and people across sectors who are here, is my call to you is think differently about de-risking. Think differently about who you're bringing around the table. Yes, government, sure, institutional investors, philanthropy, they need to be in this conversation. No, the scale is not what we want, but there's innovation and nimble capital there that can do some really, really interesting things. And I would also say family offices. At ILN, we're starting to talk to bigger networks of large family offices. Again, those are some large pools of capital that, again, are willing to take some risk and think differently about how they can catalyze larger investments. So I would think, again, how do we de-risk and don't just fall into the old ways of de-risking? And maybe I'll just highlight one partnership we've done at ILN that has focused on de-risking, but not through catalytic capital. It's focused on de-risking through project preparation. So ILN last year at the COP announced a partnership with the U.S. Trade and Development Agency, so USTDA, basically to partner with them on project preparation and technical assistance. So when our collection of investors say, or individually say, I want to invest in that country, but I need all of this project preparation, all of this technical assistance, all of this work to even, get this across the finish line. How do I do that? That's really difficult. USTDA said, no, we'll come in, we will get that done. We will find a way to make it easy for you to do the right thing, easy for you to put capital into those markets. And so I think, as we think about this and attracting institutional capital, you can get really in the weeds and we can get really, really technical about it. But I also think, as we think about this collectively as a group, there's some big, broad brushstrokes of positive impact we can do in terms of bringing the right actors around the table and think about scalability and replicability. And that is also, I'll make a plug because it just launched today, our partnership with SMI. We put out a series of blended finance case studies. Because what we heard from our investors is, show me how this is done. Not from a really avant-garde investor that we have a million reasons to say we're not like them, but show me how investors that look like us got this job done. They partnered with governments, they partnered with other sectors, and actually got an exciting new investment into a region that we are considering. So looking at that, so those case studies are out. I think it's just the beginning. I think we will continue to add to this because investors want to see how it's done and then figure out how they can replicate and scale so that the money can get into these markets, not because they're do-gooders, but because they see there is opportunity. And that's how we want to view this in emerging markets, is these are opportunities that fiduciaries see as a way to really both do good and do well.
Thank you very much, Amy. That's a great initiative, and I'm sure it's not only going to be a good read for the investors, it's also going to be a good read for governments to say, well, are these new opportunities that we can collaborate on and maybe just follow some of those steps? Excellent initiative. And when we talk about African nationally determined contributions, and we now have welcome Pablo, the head of the NDC partnership. We'll be talking about that in the next panel. But $3 trillion of NDC investment needs $3 trillion of projects to be developed. So I'd be very interested, Gunther, to get your views on how institutional assets, we've heard one example there of how, the asset owner communities partner with the likes of the support from USTDA and others. But what's your view, about how the, asset owner community can really, lean forward and lean in on assisting the project development phase? By the way, from an investment perspective, is actually much more, the returns are much more significant by investing early in project development than they are at financial close. Over to you.
Yeah, thank you. I would like to indeed build on what we just heard before. If one imagines Africa, let's say, at large, and then considers something like a diversified portfolio across Africa, who out in the investor world would not be interested in participating in this portfolio? That portfolio doesn't exist, however. That's the topic that we have, quite clearly. But per se, this is obviously very, very attractive. Now, we do have various examples, obviously. No? We have just heard, let's say, our booklets and other stuff where we can really read. Of course, we have projects that we have financed. Of course, we have projects where there is investments done. Still, there's always this discussion about the gap. The gap between, let me say, the NDCs and the investors, and how is this gap somehow closed? The investors apparently waiting for the opportunity, the NDCs somehow waiting for becoming investable. If governments would be willing to view the development of an economy, the transformation of an economy, as an enormous wealth generation, let me say for the government itself, then perhaps we could come to the conclusion, it's not only NDCs. We need to start to talk about fairly detailed plans. Let me take 3 grids: energy, transport, information. Let's assume we have development plans for all 3 of those. Let's assume we are going into a position where we can say, okay, look, this is the infrastructure that is needed for the one or the other. This is the first infrastructure project that we will come up with. And now let's assume that we have this path, we have this project, and then there is an institution for the government who auctions it out. It auctions it out to the investors. I told you, we are 88 investors, we are there. We are willing to invest. And we are very willing to face the competition. We are not believing or dreaming up just because we talk with the one or the other government, we get special conditions or what. No. It's auctioned out. But what's missing that it is auctioned out? Well, the detailed plans are missing. I dare to say this. I'm not talking about a specific country. I'm not talking about every country. There are many countries who have these specific plans. Oh, but all countries? No. It's not there. We do not have these detailed plans. And then, is there an institution who is able to auction it out? Is there such an institution? For instance, like in UK, the Infrastructure Investment Bank. At earlier stages, it was called the Green Investment Bank. It's an UK example. There are other countries with similar examples. But the examples from history are not sufficient. We are talking about a fundamental transformation of economies. So we need to think about some forms of institutionalization that is fit and proper for this fundamental transformation. And we as investors do have the feeling, and I apologize for framing it that clearly, we do have the feeling governments don't take this opportunity to auction out the transformation. And that's curious. It's really curious. Because this allows, of course, for reaping quite some benefit. Just see the auctioning out of permissions for windmills, wind farms, UK, Germany, Netherlands, wherever you want to have it. That's, of course, driving quite some on-top wealth that can be reaped by just auctioning it out. But the auctioning out needs to sit with a certain form of institutional layer. And I would recommend to do, yes, NDCs, the detailed plans. The 3 grids is a good start for these detailed plans, identifying projects in these detailed plans, and then have an institution that is able to really talk to the market and say, okay, look, this is the opportunity, now come in. And we would be very willing to take the challenge, absolutely. We are very willing to take the challenge. At the moment, the detailed plans are not necessarily there. This institutional layer is not necessarily there. And this is why we talk project by project. Who can we show another project so that we can learn from this other project? This is very good, absolutely, this is very, very good. But why not institutionalize it?
Thank you very much. Very clear, Gunther. Now, I think this is part of the new partnership opportunity, where we have to come together and think about scale and have a shared interest in the outcome and the pursuit of that particular opportunity. And I think that future opportunity is very aligned with you, Duncan, and sovereign wealth funds' ability to invest for future generations. And then I think Amy made the point about philanthropies can do some really smart things with their resources. I'd be interested to get your view about how sovereign wealth funds could work with philanthropies to solve some of these issues that Gunther's talking about, and form new institutional investor-public partnerships with governments to deliver new and ambitious infrastructure, NDC-aligned investments. Over to you, Duncan.
Thank you.
I gave you the shortest question, by the way.
And I appreciate it.
Yes.
A couple of things. Firstly, just my immediate reaction to what Gunther says. What could possibly go wrong with, some Europeans coming in and owning some of Africans' key economic assets? I'm sure that will be popular. Not. So logic is one thing, political reality is another, is what I'd say. You've got to take that into account. But look, let me quickly just go back to what Rich was saying about allocation, just to throw you a bit of good news. So latest data that we have from sovereign wealth funds is that, yes, they are allocating more to emerging markets, precisely because of the diversification risk that we've got there. Also, they are most positive about, after the US economy, about the African economy in general as having the most growth. So there is some good news that we've got in there. And also, the latest we've got from when it comes to climate-related investment, then sovereign wealth funds certainly find Africa the most popular continent in terms of where they favour putting those investments. It is also the least popular continent. So it's got those two extremes. So there's a polarisation among funds. So I think that actually says something. But then let's go into the around the risks. And most of you will think of sovereign wealth funds as those big, as I've mentioned before, the Gulf funds or the Singaporeans, people like that, or the Norwegians. But and there's a lot of significant amounts of capital there. But what in Africa is also happening is there's a number of strategic development funds that have been started. Some have got dual mandates, so a save as well, but some will invest domestically. And key among those is to both de-risk projects, but also to help their capital markets grow and develop, because that's another crucial point for this. And if you take somewhere like Nigeria, here's a good example where the Nigerian Sovereign Investment Authority, it's got a savings mandate, but it's also got a domestic mandate as well. It's helped to fund and build the second Niger crossing. It's also created some institutions designed to stimulate its local market. And of course, Nigeria, 235 million population, it's got a very significant amount of local capital. Whether that goes to work in the best possible ways is debatable. But NSIA has developed Carbon Vista, a joint venture between themselves and Vitol to invest in carbon emission reduction. The Green Guarantee Company it's invested in, which is providing long-term guarantees to credit, enhanced debt instruments, and also they've got their renewable energy investment platform. That's just one fund doing that in the Nigerian market. I could point to Senegal, where Francis has done a really excellent job attracting capital and building renewable energy projects, or you can look at Gabon, where they are actually leading their discussion over nature-based solution and investing in in those forests for sustainability. So, and across a number, and there's a number of other geographies I could mention in terms of that. So, what you're seeing is that certain African countries are understanding that they need to speak the language of investors, and they need to have a very clear vehicle that will lead into those investments and will help de-risk it politically. But I think just as important, it will speak the right language for investors, which is about how they understand to get returns over a long period. And then the final thing I will leave you with is the time horizon for sovereign wealth funds. So the average time horizon for a sovereign wealth fund is 10 years. And in some cases, it's much more than that. It even goes up to 50. So they can look at this in the long term. So they are very sensible partners to have. But the individual countries need to make it as attractive as possible. And we are seeing pockets of progress, and indeed probably more than that. And the final one I'll give you is a success story, which is QIA. And Enel, the Italian company, they've got 730 megawatts in development of green energy across Zambia and South Africa. They recently just signed a big offtake contract with Air Liquide in South Africa for green energy. So there's some real progress is being made.
No, thank you very much, Duncan. And effectively, you've just been giving concrete examples of institutional investor-public partnerships, where African sovereign funds have effectively been the agents for government to actually go out there and then co-invest with peers, speaking the language, being the institution that has aligned terms and aligned fiduciary responsibilities and perspectives. So now, given everything that we've heard, Sarah, I'm coming to you, and I know that you've got, this forward-looking view, and so I'd be very interested to, and we would all be very interested to understand what you think the next key alignment steps should be for the asset owner industry, working with governments on a mandate-aligned basis to drive, more allocations to African green industrial infrastructure and nature as a globally competitive investable asset class.
So lots of very interesting comments here. The way that what I would add to this is that what is important here is to understand how capital gets deployed at scale, and then how do we build those bridges between the people who deploy capital at scale and the end use of that capital. So let me give you, simple examples, and other people have mentioned similar things. The first is pooling of different assets. So what many people want is to say, well, I have this great project in this particular country, why doesn't somebody invest in it? And from an investor who is investing large amounts of money from their computer in New York or London or wherever they are, it doesn't matter if that's the greatest project in the world, in the greatest country in the world, it's virtually impossible to invest in because it's a standalone project and because the risk will be clear and seen, and if it goes, to others' points, if it goes badly, it will have reputational problems. So how have other people addressed this in the past? What are the basic mechanisms of capital markets to address this? The first is pooling, which is, of course, putting a lot of different things together. And rather than saying, I've got a great project in this country, it's diversification by project and by country into pools where, frankly, the risk is blended and buried. And that is what you're trying to do, right? Put that risk together so that it doesn't attract the kind of attention that it will, which attracts outside attention when things blow up. I'm an investor, okay? I'm telling you how it really works. So people don't like that. So the first...
Blend and bury.
Blend and bury the risk, okay? Blend and bury the risk. So that's the first thing. So think about pooling and putting things together so that people don't focus on that one thing. It's basic portfolio theory. Do you invest in every, if one company in a portfolio blows up, that's okay if you've got a portfolio of a lot of different things. But if you're just looking at that one company, that's probably not okay. So the first mechanism is pooling, putting things together. The second is securitization, which if you can put things together in pools, you can securitize them. And so the most successful example that I know of is the U.S. mortgage-backed securities market. So it used to be in this country that if you wanted to borrow money to buy a home, you would go to your local bank and say, would you please lend me money to buy this house? And they would lend you money and they would keep it on their balance sheet. It was not pooled and it was very local, and if something bad happened in that particular town, the whole bank went under because that's where all their loans were, right? So instead, they were securitized and tranched so that essentially you slice and dice the risk so that people who want low risk buy the AAA, the top, and people who want more risk and more return buy things that have more risk and more return. So my first is blend and bury it in a pool. The second is securitize it, slice and dice it, and try to get it try to get the risk to the person that wants that kind of risk, because everybody wants something different in markets. And then the third, which I think is the biggest opportunity that has been overlooked, is actually the corporate structure, which is, old, tried and true. But if you think about the way the oil and gas industry has been built, the mining industry, the railroad industry, all sorts of obviously the tech industry, we've talked about a transformation that's been completely transformed our economy. Those are not based on projects. Those are based on companies. And so, not that I would want to, but if I did want to invest in a oil rig in the Gulf of Mexico, I would not get on an airplane and fly to the Gulf of Mexico and look for an oil rig. I would, on my computer, buy some shares of BP. And I would let them figure out which oil rig to invest in, how to put those projects together, when to get in, when to get out, how to deploy the engineering expertise, et cetera. And I think that we think about, again, scaling the opportunity to invest in green infrastructure in Africa and other sorts of green projects, having that corporate structure with people who have that real expertise and can deploy capital through capital markets is what we need to do to get it to scale. So that's where I would leave
Thank you, and that's the perfect message to close this panel. That's slightly over but that's an excellent closing point. And I think if we all come away with a perfectly clear understanding, then we haven't listened. There are new things for us to take in here. I think there are new opportunities, and I think once this percolates through and we come back again, I think there's going to be some real exciting opportunities. Parting word.
Can I give just one real-world example that links across Gunther and Duncan and Sarah's comments? Mm-hmm. So Gunther talked about identifying an infrastructure goal and having a plan and then auctioning off those rights, and Duncan kind of teased that, well, Western companies developing local mines, what could go wrong? I just want to flag the example of Peru and how they are leapfrogging Chile in terms of copper production. So Peru had massive copper discoveries. Rather than creating a national copper company or doing projects, they auctioned off the rights to develop the copper to a half dozen global multinationals. And I'm a big fan of their finance minister, but my understanding of his logic around that was they're going to get it done quickly, they're going to bring technology to bear, they're going to compete with each other, we're going to get the employment and the tax and social insurance benefit of the employment, we're going to get the tax revenue from the copper, we're going to leapfrog the Chileans in production, because we didn't try to develop it on our own. And we're also diversifying our economy because they're taking the risk that copper prices might go down. We own what we own in the ground as a nation state, but we're already forward selling some of that risk. So I think there are political realities around this, but if you're working for a minister, you are a minister, the Peruvian finance minister is a really nice guy. Get to know him. He likes good food. You'll have some, yeah.
Thank you very much. Please join me in giving a big round of applause. What a panel. What insights. Thank you very, very much.
Doing business in Africa. You can't afford to be without Africa Investor.